to joining in and great chat as always. Thank you very much for joining us here on CNBC TV18. Thanks indeed. Well, Borosil Renewables is the next company we're speaking with, again on the back of earnings, but the third quarter earnings set has been a bit muted. Margins have come in sharply lower at 26% compared to 45% last year. It is also important to note that while solar glass demand stayed strong, it was met by rising imports, which perhaps has hit sales here for local manufacturers. Pradeep Kheruka is chairman of Borosil Renewables. He's joining us now. Mr. Kheruka, it's always a pleasure having you with us here to put things into context for us and our viewers. Let's just start with that number. Things have been a bit muted, in the third quarter. Is our rising imports the main reason? What's the demand situation? What did the demand situation look like in Q3, and what is it looking like now?
The demand situation continues to be very strong, and the reason for the rising imports is because after we have sold everything that we possibly could, the country still needs more glass, and that is why they have been importing glass. The other thing, of course, which has played a role in the lower EBITDA margins, the percentage, is that there was an anti-dumping duty which was levied on imports of glass from China, which has been withdrawn or which has lapsed in August. And the full effect of that has now become visible in the shape of lower prices for us. Meanwhile, there has been an increase in the cost of inputs, which we saw in the year 2022. And both of these put together have contributed to the lower, the still very healthy EBITDA margin, but lower than what it was in the previous year, where we were looking at a situation of shortage. So, of course, that was an exceptional situation. There were very high freight rates coming in from China. The freight rates have dropped significantly. They're nearly now what they were pre-pandemic. So it's the prices are probably as competitive as they're going to get in terms of import.
Okay, all right. Good morning, Mr. Kheruka. Always good to speak to you, sir. Let's talk about the expansion that was coming on stream. The SG3, I think so, the furnace was likely to get commissioned. Has that got commissioned in the past quarter?
Yes, indeed, it has. We were able to commission our third furnace, 550 tons per day on the 26th of January, which besides being India's Republic Day, was also Vasant Panchami, and also coincidentally, the 13th anniversary of the first day that the company stepped into solar glass. That was on the 26th of January 2010. So we celebrated 3 anniversaries with that, and I'm happy to say that the results are promising. We are still measuring our paces. We are going through the paces. It's a very large installation. Unlike normal glass plant where you just have, you're done with after you've produced the glass. Here we are processing glass as well. 100% of the glass is ground and coated and tempered. So it's a very large plant. And I'm very happy.
All right, Mr. Kheruka, we got that. It's that long-awaited commissioning has taken place. Congratulations on that front. But let's talk about a couple of numbers then. Currently, you're doing in the vicinity of around 160 to 170 crores in the standalone business. Now, since you have more than doubled your capacity, when do you hit, say, 300 crores in terms of a revenue potential? Is it by the second half of the next fiscal, towards the end of it? Point number one. And also margins, the going has been tough. From around 30%, it's come down to the mid-20s or so. Give us a margin band. Given that input costs as well have cooled off a little bit, hopefully pricing has stabilized, what could the margin band be? So two-part question, ramp up of revenues and margins. Go ahead, sir.
According to me, the next quarter, which means from April to June, should see doubling of the turnover at least. And there would be attendant improvement in the margin because the fixed cost would be spread over a larger sales volume. So there should be some improvement there. I would not like to hazard a guess. I mean, it would be interesting, the improvement in the margins because of the split up.
So can you tell us raw material prices, both soda ash and natural gas, how are they right now? And do you have any long-term tie-up for gas?
We are working in India with an administered price mechanism for a part of the gas. Fortunately, we have dual fuel furnaces. So to the extent that we get gas at affordable prices, we use gas. For the rest, we are using furnace oil for the time being. So we escaped the damage from the high price of gas. Price of furnace oil has not risen that sharply. So we will take by on that.
Right.
So in terms of soda ash, I mean, what are the prices like right now, and what would the impact be, say, on your margins?
We did extensive covering of soda ash last year. So we have stocks that will last us till perhaps half this year at the older prices. And then we will wait and see whether there is any possibility of softening of prices at all. There might be some softening, but that remains to be seen.
Right. Mr. Kheruka, you said April Q1 of 24 turnover should be double, basically, year on year.
Yeah, we would plan to do that.
Starting. And margins, I remember you said steady state should be between 24 and 26%. That's where things should settle.
You see, the adjusted margin, because in the last quarter that we just saw, the third quarter, we had a one-time gain in exchange rates because the euro had come down to 80 rupees a euro, then it went back to 88. So there's a certain amount of gain there that is reflected in the EBITDA. In my call with investors yesterday, I pointed out that the actual net EBITDA was 22.7% after taking care of those adjustments. So the next quarter, which means from April to June, we should see something better than that, of course. You just mentioned figures of 24 to 26, so that we have to see what that might be.
Okay, just in terms of capacity, one last question from my side. Yes. You began by saying we sold everything. That's why imports are coming. I mean, we've basically sold out. Demand is very strong. You indicated about the fourth furnace and some delays there, right? You'd indicated a delay of about 6 months or so. This was back in November. Could you tell us what are the thoughts there? What's the plan?
The thought right now is that we are focusing all energies on stabilizing the existing new furnace that we have. Yes. And we have also been working very hard on trying to reduce costs. So there are certain things that we've done which should reduce, which should yield, interesting savings for us as the time goes by. I've not mentioned yet, but we have started a new research and development center in Pune. It's called the Pradeep Kheruka Business Research and Development Center for Borosil. And this is being headed by a gentleman, by a team of 3 people. And the leader of them is an Indian with extensive experience in Japan and Taiwan and 45 patents to his credit. And we expect that this is going to work towards finding new ways and means of reducing our cost of operations.
Okay, all right. Mr. Kheruka, we're running a little short on time, but it seems the street likes what you're talking about. Doubling the standalone revenues, margins could improve as operating leverage plays out. On the European business, if you could tell us quickly, you're looking at replacing the existing 300 tons per day facility with a 500 tons per day facility. What is the total capex for this? When does this come on stream? And will this be better margins?
So actually, there has been a reconsideration of that decision to shut down the 300 and replace it with a 500 ton. We are in fact going in for a rebuild of this furnace, a cold repair, which should start sometime in March, around the second week of March, and continue for around 2 months. The business is doing well. We are very pleased to say that the company's products are very highly rated. There's a very strong demand and very strong consumer acceptance of these products throughout the European Union. And we expect that with capex of about 33 million euros or 34 million euros that is going to be pumped in the next few months, we should see an increase in turnover by about 20% and an improvement in margins also as well because of going in for higher value products.
Okay, all right, Mr. Kheruka, always good speaking to you, sir. Thanks so much for joining in. Wishing you all the best. Hopefully margins have bottomed out. Revenues as well pick up from here. As we speak, actually, the stock has moved to the high point of the day. Well, let's get in Mitesh Thakkar then. He's joining in to